Welcome back guys, my name is Angelo. Today we're discussing an important topic you keep asking me about on a daily basis. What is better? Lump sum investing, so investing everything at once, or cost averaging into the stock market, more specifically ETFs. And now that the market dropped a bit since the end of July, you might be wondering, is this the right time to go all in, or is it better to slowly move the amount into ETFs over a certain period? Perhaps you had some cash on the sidelines you were waiting to invest at the right moment, and now you're feeling nervous about it because we're still in a difficult economic environment with high inflation and unexpectedly high interest rates by central banks. I completely understand that feeling, so let's try to figure out the best course of action in today's video. Let's begin with some basics first. What the heck is lump sum investing in the first place? Here you invest a larger sum of money all at once, usually as soon as you made the decision that this is the amount you want to invest into this asset class long term, in our case stocks in the form of ETFs. So let's say you have 15,000 euros you want to invest into ETFs, you simply place an order of 15,000 euros worth of shares of your favorite ETF right away, and that's it, you're fully invested. You sit back, relax, and let the market do whatever it's going to do, fully aware of the fact that you have no way of knowing what's going to happen in the short term anyway. Meanwhile, with cost averaging, you invest the total sum over time, split into equal amounts, which you allocate to your ETF on a monthly basis, no matter if it's up or down at the time. Perhaps you prefer this option because you feel anxious about the market right now and you think your ETF is likely to fall in price in the short run. By the way, you may know this strategy as DCA or dollar cost averaging, but since most of you watching are based in Europe, me included, hello from Austria, and euro cost averaging sounds kinda strange, I decided to stick with cost averaging as a term. I hope that's alright with you guys. Using the same amount as in our previous example, 15,000 euros, a cost averaging strategy could look like this, for instance. You could invest 5,000 euros each month for 3 months, 2,500 euros each month for 6 months, or extend the period before you're fully allocated by investing 1,250 euros per month for a year. Speaking of lump sum investing and cost averaging, if you're enjoying the video so far, don't forget to lump sum the like button and to subscribe if you haven't yet. Also, if you'd like to support me, you can find my links to the best low-cost brokers in Europe in the description below. Okay, now let's look at the pros followed by the cons of lump sum investing. Ever heard of the saying time in the market beats timing the market? By placing a lump sum investment all at once, your money has more time to grow, and on average, you end up with better returns compared to cost averaging. That's because based on history, the market trends upwards over time and is up more often than it is down. For example, since 1979, so over the past 44 years, the MSCI World Index was up 75% of the time at the end of the year, and up 65% of the time on a monthly basis. The same is true for the FTSE All World, which is my favorite way to invest globally via one ETF. Since 2003, it was up 79% of the time on a yearly basis and in 64% of the months. So historically speaking, the odds are in your favor when you invest your money all at once instead of waiting or spreading it out. Advantage number 2 is that it only requires a single decision and action and will likely save you time. After all, remember to keep the opportunity cost in mind of you researching, spending time thinking about the right time to invest, how to split up your investment for a cost average strategy, etc. The thing is, based on YouTube analytics, most of you watching are in a similar age bracket as me. So chances are you still have the best earning years ahead of yourself, and whichever amount you're currently wasting time deciding over is only a small amount of what you'll likely earn and invest over your lifetime. So is it really worth it to stress out about the exact timing of this one investment? I think sometimes it helps to zoom out a bit and put things into perspective. It might even help you to calculate your hourly rate from your job to find out how much your time going back and forth on this decision is costing you in euros. This may feel like a life-changing decision, but most likely it's not. At least that's how I view things. Okay, now let's get to the cons of lump sum investing. Since there is no way to know in which direction the market is going to move in the short term, there's always a possibility that you could be investing right before a correction or even a crash. There's no way to eliminate this risk, and sometimes crashes can take years to recover from. This is the main reason why I always try to mention that you should treat ETFs as long-term investments. You should have a time horizon of at least 5 years, ideally 10 years or more. And emotionally, seeing your portfolio in the red can be difficult if you've never experienced this before. Many people get discouraged, start reading news headlines, which are all negative by the way when the markets are down, and may even end up selling at a loss during a period like this. Meanwhile, experienced investors tend to buy more as they see moments like that as opportunities to get more shares for the same amount of money compared to when they were at their all-time high. If you're in a situation like this where your portfolio is down, I find it really helpful to look at long-term charts to see what happened after similar periods of time in the past. Chances are it will help you calm down and stay focused on a long run. Now, let's look at the pros of cost averaging. Psychologically, splitting up a large sum sum of money and investing it at regular intervals over a 3, 6 or 12-month period instead of all at once could be easier to handle for many people. Second, if the market drops while you're cost averaging, you could end up with more shares for the same amount of money compared to a lump sum investment. And third, by buying shares for a certain sum of cash on a fixed date every month, no matter how the market is doing at the time, you're building a great habit that is likely to pay massive dividends over your investment career. The same is true for lump sum investments, by the way, if you keep investing regularly afterwards and don't get discouraged as soon as you have your first year with negative returns. As for the cons of cost averaging, if the market goes up on average while cost averaging, which it statistically does more often than not, you will underperform compared to investing all of the money at the start. Second, you're still exposed to market risk. While it may feel better emotionally to invest a large sum over time in smaller chunks, a crash or correction you were trying to protect yourself from could very well happen at the end of your cost averaging strategy. There's no way to avoid this risk. Third, compared to your lump sum investments, you run the risk of never fully investing your money if emotions get the better of you during the period you chose, for example if the market drops and you see your ETFs in the red. Or alternatively, if the market has gone up too quickly in your opinion and you just want to wait it out. If you don't automate your cost averaging strategy, you may get tempted to try and time the market in the end, which doesn't work out too well most of the time. The last con is that you'll likely pay more in fees overall, since you'll need to place a lot more individual ETF orders compared to just making one large purchase. Then again, fees have become so low nowadays, often around €1 on the best low-cost brokers in Europe, so it's not as big of a con as it used to be just a few years ago. You can find the best options linked down below in the description, by the way, which is a great way to support me if you'd like to. Okay, now you're probably wondering which one of the two strategies is better. As we've established, lump sum investing outperforms in rising markets and cost averaging outperforms if the market is on a decline during your investment period. Since global stock market indexes like the MSCI World or the FTSE All World have been up more often than down historically, both on a monthly and yearly basis, you're likely better off going with a lump sum investment as soon as you made the decision that you want to invest a certain amount of money. A study by Vanguard titled Cost Averaging, Invest Now or Temporarily Hold Your Cash, where they looked at investment periods from 1976 to 2022, came to the same conclusion. Here they compared a lump sum investment with a 3-month cost averaging split using the MSCI World Index. 68% of the time you were better off with a lump sum investment compared to cost averaging, with investors experiencing a median extra return of about 2% during the first year. But I'll be the first to tell you that's easier said than done emotionally. Chances are, as long as you don't stretch out your cost averaging strategy too long, I think a 3-month period is ideal as chosen by Vanguard for their study. It's not going to make that much difference when looking back a few years later, no matter which direction the market moves. The reality is, no matter what strategy you choose, there are no risk-free returns in the stock market. Corrections and crashes are part of the journey. The only way to effectively reduce the risk of negative outcomes is to stay invested over longer time periods. And no matter which of the two approaches you settle on for your initial investment, continuing to cost average some of the monthly income from your job into a well-diversified low-cost ETF can still be a very effective way to grow your portfolio further. That's what my wife and I have been doing as well on a monthly basis since 2017, which helped our investments in ETFs grow to a significant size since then, getting us closer and closer to our goal of being able to retire early one day. Who knows, you might even get excited when you see the market decline, as you learn to view it as an opportunity to buy more shares of the best publicly listed companies at a discount. As for myself, even after knowing the data, I'd love to sit here and tell you I simply invest a lump sum right away as soon as I have a larger amount of investable cash. For example, my wife and I recently received a combined total of €8,000 in tax refunds for 2022. But the thing is, most of the time, even I split up amounts like that and invest them in a few chunks instead of all at once. Did that yield better returns when looking back than just throwing it all into the market right away? No. Most of the time it did not. I just wanted to tell you I fall into the same market timing trap sometimes, thinking I might be able to get a few more shares for my money if I just wait a little bit or don't invest it all at once. The good thing is I still end up investing the full amount within a month or two, so I make sure I don't take it too far. Alright, now let's take a look at some of the best ways to implement each strategy. If you're going for a lump sum investment of a large amount of money right away, I would definitely pick Interactive Brokers, my personal #1 low-cost broker in Europe. On Interactive Brokers you can choose between two pricing models, tiered and fixed in your account settings. I linked a Google Sheet below you can use to calculate the fees using each model to help you with your decision based on the amount you're planning to invest. Just create a copy first, then you can edit the numbers. Orders are pretty straightforward once you place your first one, and many ETFs, including my favorite, the accumulating Vanguard FTSE All World, now come with fractional shares as well, which means you can fully invest whichever amount you're planning to allocate to ETFs right away. Additionally, Interactive Brokers recently added recurring investments as a feature. These come with the exact same low fees as direct purchases and also include fractional shares. I currently have one running at the start of each month, which helps me save some time and automate my investments. The one caveat for me would be regular orders below €500 each. For those, I recommend looking at the other two brokers in my top 3 Trade Republic and Scalable Capital. That's because once you go below that amount, let's say for example you want to invest 250 euros, then even a trading commission as low as €1.25 on Interactive Brokers already makes up 0.5% of the investment amount. And if you're buying 100 euros worth of shares, you're already at 1.25%, which based on an average yearly return of 7% per year for the FTSE All, for example, would take you about 2 months to recover from on average. Meanwhile, both Trade Republic and Scalable Capital offer commission-free saving plans into thousands of stocks and ETFs, including fractional shares, which is fantastic if you're only able to invest smaller amounts on a regular basis right now. As a result, I currently have a small ETF saving plan for my 10-month-old daughter on Trade Republic, and my wife has an ETF savings plan on Scalable Capital at the start of each month, as she loves how easy that makes investing for her. Scalable is even paying 4% per year on cash right now via their Prime Plus model secured by €100,000 bank deposit guarantee in Germany. Sadly, compared to Interactive Brokers and Trade Republic, they're only available in these 6 European countries for now. Lastly, I'm not sure if this works for all investors, but at least in our case, we're even able to set up these 2 brokers in a way that they automatically collect the money from our external personal bank accounts for free before executing our commission-free recurring investments. It's a great way to really automate everything from start to finish. This is the one feature Interactive Brokers is still missing. Hopefully it's coming at some point. I linked a more detailed video guide on how to buy ETFs using each of these 3 brokers in the description below, as well as links to each of them in case you'd like to check them out and support me. Alright, hopefully I was able to cover most of the questions you had about lump sum investing versus cost averaging in today's video. Ultimately, you know yourself best and you need to make sure you're able to sleep well at night. So pick whichever strategy you feel the most comfortable with and just get started. But once you do make a decision, make sure you stick to it and don't let your everyday emotions get in the way on your journey towards achieving your long-term financial goals. Also, if you're in a similar age bracket like me, as most of you seem to be according to YouTube analytics, try to put things into perspective. Chances are you still have your best earning years ahead of yourself, and whichever amount you're currently wasting valuable time deciding over is only a fraction of what you'll likely earn and invest over your entire lifetime. So is it really worth stressing about what the market might do in the next few months, something you have zero control over, keeping in mind that you're fully exposed to market risk towards the end of a cost averaging strategy as well? This may feel like a life-changing decision, but most likely it's not. Just make a decision on how to proceed, stay the course, and move on with your life. At least that's my point of view. But now I want to hear from you guys. How do you usually invest large sums of money? A lump sum all at once, or do you split it up and cost average the amount into the market? And if your answer is the latter, over what period of time? Before I take off, if you enjoyed the video, don't forget to gently lump sum the like button. Please don't cost average it, as you might remove the like again, which defeats the purpose. And subscribe if you haven't yet. You can find links to everything I mentioned below. And if you're worried about buying ETFs at or near all-time highs, you need to watch this video next. You might be shocked by what I found out in my research. Meanwhile, if you're wondering if most passive income advice on YouTube is a scam, make sure you check out this video right here. Thank you guys so much for watching, have a wonderful week, and until next time.